Friday markets are opening under a set of conditions that, at first glance, appear familiar to anyone who has followed precious metals for years. Yet the surface narrative being circulated fails to capture the scale of what is actually unfolding beneath. Silver has been volatile, gold has shown signs of strain, and headlines have framed the situation as another bout of speculative excess working itself out through routine profit-taking and portfolio adjustment. Prices are moving, analysts are issuing notes, and most coverage treats this as a contained, technical episode. What is being missed is that this Friday is not merely another trading session, but a convergence point where structural mechanics, institutional mandates, and supply constraints intersect in a way that has the potential to disrupt long-standing assumptions about how gold and silver markets clear. By the end of this analysis, the underlying forces driving the reported $14 billion gold and silver liquidation event will be clear, along with why the question is not simply whether silver breaks this Friday, but what that break would actually represent within the broader monetary system. This is an analysis that rewards attention rather than speed, because what matters most is not the headline itself, but the implications that follow once the mechanics are understood, and the unresolved question is whether markets are prepared for the consequences of a process that no single participant fully controls. The precious metals system is generally understood as a deep and liquid marketplace where price discovery occurs efficiently through futures exchanges, exchange-traded products, and institutional trading desks that connect global buyers and sellers. Gold and silver prices are assumed to reflect a balance between industrial demand, investment interest, central bank activity, and macroeconomic expectations, with derivatives providing liquidity and risk transfer that stabilizes the system. Index funds, commodity benchmarks, and passive investment vehicles are viewed as neutral participants, reallocating capital according to transparent rules that smooth volatility over time. This framework rests on several assumptions: that paper markets remain sufficiently liquid to absorb large flows, that physical supply can be mobilized when price signals demand it, and that institutional actors retain the flexibility to manage stress through timing and scale. Under normal conditions, these assumptions hold well enough to maintain confidence. However, current conditions are eroding them simultaneously. Price movements are no longer being driven primarily by discretionary decisions, but by rules-based obligations, while physical inventories are showing signs of strain that price alone is failing to resolve. Stress is not theoretical at this stage. It is already visible in delivery timelines, expanding premiums, and the increasing divergence between what contracts imply and what metal can actually be sourced. History provides a useful lens for understanding why such divergences matter, because markets have encountered similar moments before when confidence in paper mechanisms outpaced the underlying capacity of the system. In the late 1970s, silver markets experienced a rapid escalation in price driven by inflation fears, geopolitical uncertainty, and concentrated accumulation, culminating in extreme volatility when exchanges and regulators intervened to restore order. Authorities imposed position limits, altered margin requirements, and effectively changed the rules of participation midstream in an effort to prevent systemic damage. Prices collapsed, not because the underlying monetary concerns vanished, but because the structure of the market was forcibly reshaped to protect institutional stability. A more recent parallel emerged during the 2008 financial crisis, and again in the March 2020 liquidity shock, when paper prices for precious metals fell sharply as funds liquidated positions to meet margin calls, even as physical demand surged. In both cases, the response focused on preserving financial plumbing, rather than reconciling paper claims with physical availability. Over time, confidence returned, but only after extraordinary intervention and the expansion of central bank balance sheets. These episodes are relevant not because they predict identical outcomes, but because they reveal a consistent mechanism. When trust in financial intermediaries weakens under stress, authorities prioritize system continuity, often at the expense of price signals that would otherwise ration scarce assets. The pattern that emerges across these events is clear. Systems built on leverage, derivatives, and passive allocation perform smoothly until they encounter a constraint they cannot bypass, whether that constraint is liquidity, collateral, or physical supply. Early warning signs are typically dismissed as noise, explained away as technical anomalies or short-term distortions that will self-correct. Yet as pressure accumulates, actions become increasingly mechanical and reactive, amplifying volatility rather than containing it. The market begins to move not because participants change their outlook, but because rules compel them to act. In such environments, price ceases to be a reliable signal of equilibrium and instead becomes a reflection of forced behavior. The question confronting silver markets now is whether the current liquidation event represents another manageable adjustment or the early stage of a broader decoupling between financial representation and physical reality. What differentiates the present moment from prior episodes is the absence of buffers that once absorbed shocks. Physical silver inventories are already constrained by years of underinvestment in mining capacity, rising industrial consumption driven by energy transition technologies, and persistent retail accumulation. Unlike earlier periods when refineries and mints could rapidly increase output to meet surging demand, current supply chains are operating near capacity with limited flexibility. At the same time, geopolitical fragmentation has reduced coordination across markets, while regulatory frameworks have become more rigid, leaving less room for discretionary intervention. Institutional actors facing mandatory rebalancing or liquidation do not have the option to wait for calmer conditions or to source physical metal to offset exposure. They must execute within predefined windows. This rigidity transforms what would otherwise be a routine adjustment into a stress test. Conventional tools such as margin adjustments or temporary liquidity facilities address paper imbalances but do nothing to resolve physical scarcity, making their effectiveness increasingly questionable. The near-term pressure window centers on this Friday because it is when multiple constraints align. Mandatory selling tied to index rebalancing and portfolio limits converges with thin physical inventories and heightened geopolitical risk, compressing timelines and narrowing options. Market participants range from passive funds executing rules to leveraged traders managing risk to long-term holders seeking protection from monetary debasement. Their incentives diverge and their actions interact in ways that can produce abrupt outcomes. Policy responses, if any, are likely to be reactive, shaped by the need to maintain orderly markets rather than by a capacity to address underlying shortages. The strongest tension lies in whether the resulting price movements will restore confidence by flushing excess leverage or undermine it by exposing the limits of paper settlement in the face of real demand. Much of the public narrative seeks to reassure investors that large liquidation events are inherently neutral, that markets have absorbed similar flows before, and that arbitrage will ensure alignment between futures, exchange-traded products, and physical prices. Such arguments overlook the structural conditions that make arbitrage possible in the first place, including available inventory, financing capacity, and confidence in delivery. Stability in narrative does not equate to resilience in system design, and repeated reliance on explanation rather than resolution risks compounding fragility. When price declines fail to elicit physical supply, or when lower spot prices coincide with higher acquisition costs, the credibility of the benchmark itself comes into question. What this analysis reveals is that the issue at stake is not whether silver breaks on a given Friday, but whether the mechanisms that define price are still capable of reconciling financial claims with tangible assets under stress. The liquidation event is a process rather than a single moment, and its significance lies in what it exposes about the evolving relationship between money, commodities, and trust. If paper markets can clear without regard to physical constraints, what does that imply for long-term holders seeking stability? Conversely, if physical scarcity asserts itself despite financial pressure, how will institutions adapt their models of risk and allocation? These are the questions that will shape precious metals markets well beyond this week. For those who want to follow how these dynamics evolve before they crystallize into headline crises, continued attention will be essential because the most consequential developments rarely announce themselves in advance. Markets entering the second phase of this analysis must now be viewed through the lens of mechanics rather than sentiment, because what drives the next moves in silver and gold is not fear, optimism, or narrative positioning, but obligation. The liquidation event referenced in the title is rooted in the structure of commodity benchmarks and passive exposure vehicles that dominate institutional allocation today. The Bloomberg Commodity Index, along with similar benchmarks, operates under predefined weighting rules that are recalculated at fixed intervals. When a component such as silver dramatically outperforms over a calendar period, its weighting exceeds mandated thresholds, forcing index tracking funds to sell exposure regardless of outlook, valuation, or market conditions. This process is automatic, contractual, and immune to discretion. It transforms what appears externally as a market decision into a mechanical transfer of risk that must occur within a compressed time frame, concentrating pressure rather than distributing it. The scale of the current adjustment is what elevates it from routine to destabilizing. $14 billion in combined gold and silver exposure represents not marginal flow, but a significant percentage of open interest in near-dated contracts. When flows of this magnitude are introduced into a market already experiencing tight physical availability, the assumption that liquidity will seamlessly absorb the impact becomes questionable. Futures markets are designed to net positions efficiently under normal conditions, but they rely on a constant rollover of confidence that contracts can be offset or settled without friction. When selling is concentrated and time-bound, bids thin out, volatility rises, and price begins to move faster than risk models anticipate. This is not because participants are irrational, but because they are constrained by the same rules simultaneously. As selling pressure materializes, a familiar argument emerges: that futures liquidation does not matter because most contracts are cash settled and rarely result in physical delivery. On paper, this is correct. The majority of contracts are closed out prior to expiration, and delivery percentages remain low. However, this argument overlooks the signaling function of futures prices within the broader ecosystem. Spot prices, lease rates, and even retail premiums reference futures as their anchor. When that anchor is subjected to forced selling disconnected from physical supply, the informational content of price degrades. The market begins to communicate abundance where none exists, or scarcity where supply is constrained, creating feedback loops that distort behavior across all layers of participation. The physical market, operating in parallel, is responding to a different set of inputs. Fabricators, mints, and dealers are not responding to index weightings or portfolio models. They respond to inventory levels, delivery lead times, and replacement cost. When wholesale bars become scarce, premiums expand not as an expression of speculation, but as a rationing mechanism. This divergence is often misunderstood as inefficiency, when in reality it reflects two distinct clearing processes. The paper market clears claims, while the physical market clears metal. When the two are aligned, prices converge. When they diverge, it is a signal that the system is under strain. This divergence has implications beyond silver alone. Gold, while deeper and more liquid, is subject to the same structural dynamics, particularly as central bank accumulation, sovereign repatriation, and geopolitical hedging remove metal from circulation. The liquidation of gold exposure alongside silver compounds the effect by signaling broad-based deleveraging in precious metals, even as underlying demand drivers remain intact. Investors interpreting price weakness as a reduction in systemic risk may be misreading a process that is instead revealing how dependent price stability has become on continuous confidence in paper instruments. The institutional response to such stress is typically framed as risk management, yet risk models themselves are backward-looking constructs calibrated to periods of relative stability. They assume correlations that hold until they do not, liquidity that persists until it evaporates, and counterparties that perform until they are simultaneously forced to act. When selling is mandated rather than elective, these assumptions unravel quickly. What follows is not a smooth repricing, but a sequence of air pockets where price overshoots fundamentals, often in both directions, before finding temporary balance. As this process unfolds, attention shifts toward who is positioned to absorb the flow. Sovereign entities, long-term accumulators, and industrial users operate on horizons that differ markedly from index funds. Their participation depends not on price momentum but on strategic necessity. Yet even these actors face constraints, whether political, logistical, or regulatory, that limit their ability to step in immediately. The result is a window in which price moves faster than physical flows can respond, amplifying the apparent break implied in the title. The question then is not whether silver can withstand a liquidation event in isolation, but whether the architecture supporting price discovery remains credible when confronted with structural selling against a backdrop of constrained supply. If prices fall sharply yet premiums rise, if inventories fail to replenish despite lower benchmarks, and if volatility persists beyond the rebalancing window, the signal to the market will be unmistakable. It will suggest that the break is not merely technical, but conceptual, reflecting a system increasingly reliant on representation rather than substance. What follows from that realization is where the analysis must now turn, because history suggests that once such a threshold is crossed, the consequences extend far beyond a single Friday. The third phase of this examination moves beyond mechanics and into recognition, because once a system begins to exhibit stress across multiple layers simultaneously, patterns emerge that are difficult to dismiss as coincidence. What is unfolding around this liquidation window follows a trajectory that has appeared repeatedly in monetary and commodity systems built on leverage and abstraction. Confidence erodes first at the margins, where participants notice small inconsistencies between price signals and lived reality, then accelerates as those inconsistencies become persistent rather than episodic. In the case of silver, the inconsistency is no longer subtle. Futures prices suggest availability and liquidity, while physical markets signal scarcity and delay. This is the same early-stage fracture that has preceded major repricing events in the past, not because of panic, but because the informational function of price begins to fail. Historically, such moments are misread precisely because they do not initially resemble crises. They appear as technical events, seasonal adjustments, or routine reallocations that analysts have seen before. The danger lies in extrapolating past outcomes without accounting for present conditions. In earlier cycles, when similar liquidation pressures emerged, the system possessed slack. Inventories were larger, geopolitical alignments were more stable, and monetary authorities had room to maneuver without immediately undermining confidence in currency. Those buffers allowed temporary dislocations to resolve themselves quietly. Today, those buffers have been largely consumed. Years of financialization have expanded paper claims far faster than underlying supply, while persistent monetary intervention has conditioned markets to expect backstops that may no longer be politically or economically viable at scale. The recurring pattern becomes clearer when viewed through the lens of trust. Paper markets function efficiently only so long as participants believe that claims can ultimately be honored, either through delivery or through an orderly netting process that preserves value. Once doubt enters that equation, behavior changes rapidly. Holders of physical metal become less willing to sell into weakness, while holders of paper claims become more sensitive to volatility and counterparty risk. This asymmetry amplifies divergence. Price declines no longer attract supply. They attract demand that cannot be met. The result is not equilibrium, but tension that builds until resolved by repricing rather than adjustment. This is where the question posed by the title takes on deeper meaning. Asking whether silver is breaking this Friday implies a discrete event, a moment of failure or confirmation that can be observed and then moved past. In reality, what matters is whether this period marks the transition from a system that occasionally experiences divergence to one where divergence becomes persistent. If forced liquidation produces a temporary price shock that is quickly absorbed, confidence may be bruised but intact. If, however, the shock exposes an inability of paper prices to mobilize physical supply, the implication is far more consequential. It would mean that price is no longer performing its primary function as a signal of scarcity and abundance. At that point, attention inevitably shifts toward what differentiates the present from past episodes in a more fundamental sense. Structural demand for silver is no longer cyclical in the traditional way. Industrial consumption tied to electrification, data infrastructure, and energy transition does not recede simply because financial conditions tighten. Monetary demand, driven by distrust in currency and sovereign balance sheets, is similarly insensitive to short-term price fluctuations once confidence in the system weakens. These forces create a floor under physical demand that paper markets alone cannot override indefinitely. The recognition phase is often the most uncomfortable because it challenges deeply held assumptions without yet offering clarity on resolution. Market participants sense that something has changed, but consensus lags because the change does not fit neatly into existing models. Analysts debate whether signals are temporary distortions or early warnings, while price action oscillates violently as opposing interpretations collide. This is the environment in which breaks are misidentified or dismissed until they are unmistakable. What follows from this recognition is the most difficult question of all, and it cannot be answered by reference to history alone. If the familiar tools that once stabilized similar situations are now constrained or exhausted, what replaces them? This is where the analysis must turn next, because understanding why this time may be different requires confronting limits that have been building quietly for years. The liquidation event may pass, but the conditions it reveals will not, and the market's response to those conditions will define not just the next move in silver, but the credibility of the system that prices it. The fourth stage of the analysis confronts the central issue that separates this episode from earlier periods of stress. Because the system facing pressure today is operating with constraints that did not exist when similar patterns appeared in the past. In previous cycles, policymakers, exchanges, and institutions had room to absorb shocks through surplus inventory, discretionary intervention, or coordinated action across jurisdictions. Today, that margin of safety has narrowed dramatically. Physical silver supply has become structurally tight after years of underinvestment in mining and refining capacity, while demand from industrial users tied to electrification, data infrastructure, and defense technology has become embedded rather than optional. This demand does not respond elastically to price declines, meaning that even sharp drops in paper prices fail to unlock meaningful additional supply. At the same time, the financial architecture surrounding precious metals has grown more rigid. Passive investment vehicles, index-linked strategies, and rules-based risk management dominate flows, reducing the role of discretionary judgment at moments when judgment matters most. When liquidation is mandated by formula rather than choice, timing becomes compressed and flexibility disappears. Institutions cannot wait for volatility to subside or for physical markets to respond. They must execute according to schedule. This rigidity transforms what might once have been a manageable rebalancing into a concentrated stress event, magnified by the very systems designed to provide stability. Geopolitical fragmentation compounds these constraints. The global environment that once supported seamless arbitrage between regions is fracturing under sanctions, trade restrictions, and strategic stockpiling. Metal that might previously have flowed freely to meet shortages is now held back by national policy or long-term strategic considerations. Central banks accumulating gold are not price-sensitive sellers, and industrial consumers securing silver for critical applications are prioritizing continuity of supply over cost optimization. These behaviors remove metal from circulation in ways that are not easily reversed, further reducing the pool available to respond to paper-driven price signals. Monetary conditions add another layer of difference. The credibility of fiat currencies has been steadily eroded by persistent deficits, rising debt servicing costs, and the normalization of extraordinary intervention. In earlier eras, tightening policy or restoring fiscal discipline provided a credible path back to stability. Today, those options are constrained by political reality and economic dependence on low rates and abundant liquidity. This shifts the role of precious metals from speculative assets to strategic hedges, altering how holders respond to volatility. Long-term accumulators are less inclined to sell into weakness, particularly when weakness is perceived as the result of mechanical selling rather than a deterioration in fundamentals. These factors converge to limit the effectiveness of conventional solutions. Exchange interventions, margin adjustments, or temporary liquidity facilities can address price volatility in derivatives markets, but they cannot conjure physical metal where it does not exist. Narrative reassurance can slow panic, but it cannot force supply into a market constrained by geology, infrastructure, and geopolitics. As a result, the system is left with fewer levers to pull at precisely the moment when stress is becoming visible. This is why the question of whether silver is breaking this Friday cannot be answered by reference to price alone. A brief decline followed by recovery would not negate the structural issues now exposed. What matters is whether the mechanisms that once synchronized paper and physical markets can still function under these constraints. If they cannot, then even a temporary stabilization will mask a deeper shift in how value is discovered and preserved. The implications of that shift will become most apparent not in the immediate aftermath of liquidation, but in the window that follows, when markets attempt to return to normal and find that the old pathways no longer lead where they once did.